variety of statutes. I mean, for FDI, there are variety of statutes. This is probably the agenda for today. Various statutes of FDI, the various routes, what are the eligible instruments and pricing, how the consideration needs to come into India, the transfer of shares between residents, non-residents, etc. Other aspects, there are some other aspects, some points which needs to be taken into consideration. How to calculate foreign investment, FDI in LLPs. This is something something new. FDI in NBFC. These NBFC and real estate are probably the sectors which, if time permits, we can discuss, and the compliances.
Time permits, we have
Today.
Expanded.
Yeah. So, FEMA basic aspect. I mean, we need not get into much of the details here because few of the sessions, already we have gone through it. Definition of person, resident in India, non-resident, person of Indian origin. So now let's start with FDI. So we'll be basically dealing with FDI. There are other routes as well. We might get into that a little later on. So these are the various statutes. FEMA Act. Section 6 of FEMA Act is basically the starting point from where it all starts. I mean, from section 6, capital account transactions, where it all starts, and section 6(3) definitely specifically gives power to RBI to make regulations, and out of that, through that, FEMA 20, FEMA transfer or issue of security by a person resident outside India regulation 2000 has been issued by RBI. The next set of regulations which are RBI notifications and circulars. I mean, day-to-day various notifications, circulars, and all are issued by RBI. Frequently asked questions. These are specific. These are provided on our website of RBI, wherein that's a simple question-answer form for laymen to be understood. Then there is Master Circular on Foreign Investment in India. This is basically consolidation of all the circulars issued by RBI with respect to this specific subject. Next is FDI policy. I mean, FDI policy is basically issued by DIPP, Department of Industrial Policy and Promotion, and it is also basically a consolidation of all the press notes issued by DIPP. FDI is basically regulated by two authorities. One is DIPP and one is RBI. As far as sectors are concerned, conditionalities, the how much percentage is to be allowed, etc. All those things are dealt by DIPP, which is a central government ministry, and the foreign exchange part. I mean, the dealing in foreign exchange, the pricing, how much consideration should come in, which of the through which routes, those are being dealt by RBI. So these are basically the two the authorities controlling FDI. Now these are various routes through which foreign investment can come into India. One of it is FDI. There are others as well. FDI also is basically further divided into two routes. One is automatic route and government route. Automatic is basically there is no need for any permission and all. Simple compliances can be made. And government route are basically for certain sensitive sectors wherein government needs to take control of things. So those investment into those sectors need to be passed through FIPB or government, basically central government. Second is portfolio investments. These are under these things, FIIs, foreign institutional investments, FPIs, foreign portfolio investments, and even NRIs, QFIs and PIO. NRIs is non-resident Indian, PIO is person of Indian origin, and QF is qualified foreign investor. Then is FPCI. I mean, these all things will be dealt a little later on. Basically, we are concentrating on FDI. It is just that this is showcasing the various routes through which foreign investment can come into India. Last part, we can say capital and profit share in LLPs, and this is basically foreign direct FDI, foreign investment into LLPs. This has been recently introduced under RBI regulations. Earlier it was there in FDI policy, but RBI was totally silent on LLPs. Recently RBI has introduced this Schedule 9 specifically to deal with LLPs. I mean, foreign investment can also be done through branch and liaison office, which we had dealt earlier. So these are now this is basically the routes are suited for specific for different types of investors. Different investors have different objectives of investing into India. For investors who are strategically investing into India and they actually are interested in the business of the company, they will opt for FDI route. Whereas for the investors which are basically want to enter into secondary market and make profit out of that, for them it is basically FIIs, foreign portfolio investors. Foreign venture capital investment, and venture capital investment is basically for investment into startup companies. Basically those are unlisted companies, and there are also investment allowed in NCDs, other kind of government securities which can be done by FIIs, FPIs, etc. FEMA 20. This is basically these are the various schedules which specifically deal with various types of investments. We will be today doing Schedule 1, FDI scheme for foreign investors, 2, 2A, 3, and those are various institutional investment, foreign portfolio investment, etc. And Schedule 9, which is acquisition, transfer by non-resident of capital contribution or profit share of LLPs. Basically foreign investment into LLPs. So this is an overview of the various schedules of FEMA. Now coming on to FDI, today's main topic for discussion. This definition is as per the FDI policy. FDI means investment by a person resident outside India in the capital of an Indian company under Schedule 1 of FEMA 20, foreign exchange management and transfer or issue of security. So as per the FDI policy also, it says the person which is resident outside India can invest into the capital of an Indian company under Schedule 1. Schedule 1 is which we had discussed earlier, which have various conditions set in for FDI investment. Now who can invest? Various entities can invest. Body corporate, incorporated outside India. That can also be FII, FPCI or financial institution. I mean, basically FII, FPCI are also entities. So those entities can well invest under FDI route. It is not that they can only invest in FII or venture capital route. They can well invest under FDI route. If they are investing under FDI route, they have to meet up with the specific conditions and the sector caps, etc. of Schedule 1 and the compliances of that. So even FII and FPCI can invest under FDI route. The second is non-resident entity. I mean, there can be PE fund, foreign trust, partnership, proprietary firm, foreign citizens, and non-resident Indians and person of Indian origin. So these are the various entities who possibly can invest under FDI route. And so this is the first aspect, person resident outside India. Second is capital of an Indian company. Now what is capital? Capital, as far as FDI is concerned, capital is equity capital, equity shares, fully compulsorily and mandatorily convertible preference shares. Optionally and all are not allowed. Only fully convertible, fully compulsorily and mandatorily convertible preference shares are allowed. Fully compulsorily mandatorily convertible debentures. And warrants and partly paid up shares. Warrants and partly paid up shares is a recent thing, which probably in July 2014 it has been introduced. So earlier it was not there. So basically the intention here is to invest into the equity. Even if you are investing into other instruments, those are finally getting converted into equity. So the intention is investment in the equity of the business. OCBs are probably overseas corporate bodies, which is defined as 60% of the capital in OCBs is owned by non-resident Indians. they have been specifically de-recognized. Not much of relevance as far as practical scenario in today's scenario is concerned. It is basically way back in 2003 when they had introduced these regulations. So these are the various types of routes wherein FDI can flow. One is approval route. Approval route is basically wherein FIPB or DIPB or central government approval is required before investing into any sector. So approval from FIPB, SIA, the full form is Secretariat of Industrial Assistance, SIA. Activities in Annexure B where entry route is FIPB. I mean, Annexure B is basically an entire annexure listing down various sectors, conditionalities, the percentage up to which FDI is allowed. So if in the annexure itself the sectors fall under central government approval route, so those sectors will be for those sectors investment in those sectors will require FIPB route. For example, multi-brand retail or defense or agriculture. Those are the sectors wherein even 1% investment requires government approval. So those are the sectors. Investment beyond sectoral caps. So if only 49% is allowed for that matter, so if you want to invest beyond that, government approval will be required. Investment in holding companies. Holding companies are probably only companies which only are in existence for making investments into other companies. They are not operating companies by itself. So investment in pure holding companies will also require government approval. And investment in various kind of there are the other form of investments wherein where non-cash consideration. For example, if I am issuing shares for against import of capital goods paid or pre-operative expenses or incorporation expenses or share swap. So these are four kind of this thing. If I am issuing shares against my capital for payable against my, if I am issuing shares against the import of capital assets payable, so for that again central government approval will be required. Against pre-operative and pre-incorporation expenses, promoter incurring some expenses and issuing shares against that, again that will require FIPB approval. Share swap, issuing shares in consideration of in some shares, so even that will require FIPB approval. So these are the various avenues wherein FIPB approval is required. Second is automatic route. Automatic, most of the sectors are probably the sectors wherein FDI is freely allowed. So even in Annexure B there are where it is written, where it has been specifically written, investment is allowed under automatic route. For those sectors there is no need for any FIPB approval, as investment can be made and related compliances should be done. Investment to fall within prescribed sectoral caps and stipulated guidelines. It should be within sectoral caps and it should be also complying with the conditions which every sector has. Investment can be through inward remittance at fair value. I mean, pricing is also an issue which needs to be complied with. Post facto filings with RBI. Issue of shares against conversion of ECBs, royalty, technical know-how fees, import of capital goods by units in SEZ subject to certain conditions. These are some of the non-cash consideration wherein automatic there is no requirement of a FIPB approval subject to certain conditions which we will specifically deal in the later slides. Now there is a list of prohibited activities. For example, gambling, lottery business, real estate, TDR, Nidhi, chit fund companies, atomic energy. I mean those sectors which are not open for private sector, only government can do that. So those are the list of prohibited activities wherein FDI is not allowed at all. Issue of warrants and partly paid up shares. This we can deal later.
Chintan, just one question.
Yeah.
In the automatic route, the last point is issue of shares against conversion of ECB's royalty. This is applicable only for SEZ units.
No, as far as import of capital goods by units in SEZ.
Chintan, one doubt here that issue of shares against conversion of ECB, is it issue of only equity and preference shares or even CCDs will be allowed? The issue of CCDs against ECB, as in if I convert ECB and issue CCD, will that be allowed?
CCD should be.
Because what I
the CCD, he's saying because it may be converted into shares.
yes. No, why I'm coming to that, because that circular which was issued, which about that legitimate use, so there they have specified as per the extant provisions, the issue of equity shares and convertible debentures will be allowed. But if I look at the underlying notification 20, there they do not specify debentures. There they talk about only shares and
Correct. Even in master circular, it is for issue of shares and preference shares. They have not specifically said.
Master circular and FDI, they specify again debentures.
No, this is master circular on foreign investment in India.
Then I think it's vice versa. Somewhere ECB, master circular and ECB has some conflict again.
Okay. I mean, as far as ECB, the common hiding here is conversion into equity. But I mean, from there you cannot specifically draw whether it is allowed or not. But as far as FEMA 20 is concerned, here it is written only for issue of shares and preference shares. I mean, CCDs have not been written specifically in the.
So far as this fully convertible debentures or any financial instrument which is fully convertible, it will be allowed.
No.
And it should be unconditional.
No,
What are the notifications of shares? The master circular cannot override the notification.
Right.
So notification doesn't include CCDs, and even master circular, I think we should look at the notification.
That's right.
What is the notification? You said
equity
that
and preference
doesn't
shares.
include
It is equity and preference
Master
shares.
circular and the recent APBI circular.
That's a
they
master
talk about
circular, right?
conversion.
This is master circular. This is
But
FEMA 20,
notification does not.
the regulation.
Notification. What is?
No, the schedule 1 FEMA 20, the regulation, which is above all. So it says only may issue equity and preference shares. That's it. Nothing. No this thing to debentures.
If you go to the master circular of the ECB, the preference shares which are not compulsorily convertible are classified as a debt.
Correct.
So
Correct.
you have to read in that context. That, if it is anything which is unconditional conversion, then it goes to equity. If any condition attached other than the time, then it is a original mode it has to go. That's the interpretation thing.
That's right. If you combine both.
So you cannot issue redeemable preference.
Yeah, you
No,
can
you cannot.
also-
You
Yeah,
cannot.
that's
You
what-
cannot. No.
Non-convertible instruments. Assuming it is under FDI.
No, the language specifically says only equity and preference shares. There is no mention of any debentures. So probably.
She is talking CCDs.
CCDs. Yeah, again.
I think for one of my clients we have checked with RBI. So far it is fully convertible instrument.
Yeah, it is going into equity.
Preferential or debentures, it is allowed.
It is allowed.
It is considered as a equity if it is compulsory.
Okay.
So all FDI eligible instruments can be converted.
I mean, it
Like
is
ECB can be converted into
No.
equity, CCPS and
CCD.
Yes.
I mean, as far as CCD is concerned, I mean, it's better to practically check with RBI on a case-to-case basis. That is the most practical thing.
Anyway,
Because-
it is approval route. If ECB
No, for royalty, technical fees, ECBs, those things, it is not approved. It is automatic.
Can this conversion happen from like investment on non-repatriation basis? NRI has given a ECB to a company where he is more than 25% shareholder, and he is converting those shares of the ECB into equity on non-repatriation basis. Because ECB master circular says that you have to file FCGPR form and all that.
Correct, ECB 2 and all.
But those regulations are not applicable to Schedule 4, like
Yes,
non-repatriation
yes.
basis.
And even the one of the condition while conversion is that ECB itself should have that conversion this thing. Okay, ECB should be one of the conditions. It should be it should be convertible into equity shares.
Yeah, but everywhere they are asking like at the time of conversion you have to file FCGPR and pricing and everything you have to do.
Correct.
Similarly, NRI is allowed to invest on non-repatriation basis. So can we convert that ECB into equity shares on non-repatriation basis? Then I don't have to do the FCGPR
Right.
filing, valuation and all those things.
So that will not come under FDI.
That will come out.
That won't.
That is allowed because everywhere they say you have to file FCGPR at the time of conversion.
See, till the time it conversion, you have to follow the ECB rule. The moment it is converted, then you have to follow one-time filing. And
No, but
it's
that,
like
see,
FCC we want
FCC
to
is
talk
basically
about.
FDI, and FDI is always repatriation basis. If it is non-repatriation basis, it will go to schedule 3, 4 for PIO and NRIs. So there we need to check out whether it's possible or not. But as far as FDI is concerned, it is always on repatriation basis.
If you take any prospectus of the FCCD, foreign compulsory convertible bonds, you will get all these regulations.
These are the illustrative list wherein FDI is allowed under automatic route. As far as automatic manufacturing sector, there are certain small reservations for MSE sector, but otherwise manufacturing sector in all is completely free for 100% FDI. Cash and carry wholesale trading, insurance, there is a cap. There is development of housing townships, broadcasting only up to 49%, infrastructure and shipping, hotels and tourism, list of activities. And wherever the bracket A has been written, it is basically those sectors apart from FDI, you have to also comply with various conditions which have been specifically mentioned in the Annexure B. So for example, in any NBFC or in development of housing, there is minimum capitalization requirement. Whenever you are investing into an NBFC, minimum certain amount of USD you have to bring in as a foreign investor. So those are the various requirements which have been specifically listed down in Annexure. Approval route, I mean asset reconstruction companies, existing airports, these are the various approval routes. Multi-brand retail, single brand retail, telecommunication, and prohibited sectors. Prohibited sectors is sectors which are not open to private sector investment, atomic energy, railway transport. There has been a recent amendment wherein some of the railway infrastructure, investment into some of the railway infrastructure has been permitted. So apart from that, other railways at large, other activities are not covered under, are not permitted for FDI. Lottery, betting, gambling, cigar, cigarettes, real estate, etc., etc. These are the kind of businesses wherein FDI is not allowed.
With the activity which is not in any of these three?
If activity is not listed, it is allowed. If there is no mention of the activity in Annexure B, so FDI is allowed in those sectors.
As good as automatic?
As good as automatic, yes. Now these are the various instruments wherein FDI, I mean through which FDI investment can be made. Equity shares. I mean there's not much to explain here, but it also includes partly paid up equity. This is a recent amendment which has been dealt in later slides. Equity can be in variety of form: fresh issue, bonus, right, conversion, and preferential allotment. So these are the various forms wherein equity or CCPS or CCDs can be issued. Certain conditions have been attached to CCPS. CCPS, I mean, as far as dividend is concerned, dividend on preference shares, compulsory convertible preference shares, should not exceed 300 basis points over PLR of SBI, which is currently 14.75%. So the dividend on preference shares should not be more than 17.75%. So that is the restriction which has been imposed specifically in FEMA regulation. As far as CCDs is concerned, there is no such cap, but practically, preferably, the same this thing is followed, 300 basis points plus SBI, practically. But as far as regulations or FDI policy or master circular is concerned, there is no specific any cap on the interest rate on CCDs. And even the time frame for conversion has not been specified in the regulations. 20 years is the time frame which comes from the Companies Act. So probably that is the upper limit. Otherwise, there is no specific time frame provided in the FEMA regulations for the conversion period. ADRs, GDRs, these are also the one of the form of FDI, and warrants. Warrants also has been recently introduced. Partly paid up shares and warrants has been recently introduced. Earlier it was an FDI policy. Under FDI policy it was under approval route. But while introducing recently under RBI regulation, there is no mention of any approval or this thing. So I mean, practically we need to check whether actual approval is required or not. As far as regulation is concerned, there is no requirement of any approval on issue of warrants or partly paid up shares. But under FDI policy, earlier it was required. FDI policy, the latest FDI policy is on April 2014, and the recent amendment is in July 2014. So we don't have an updated FDI policy, and as far as RBI regulation notification through which it has been inserted, there is no specific requirement of any approval. So this is a new thing. So probably practically we need to check with the RBI whether approval would be required for partly paid up shares or warrants. So that we can, that is an open issue. Put and call options have now been open to foreign investors, but it is in a very restricted manner. So there is a lock-in period, and there is also the pricing restriction. We have dealt it later. Non-partially optionally convertible debentures or preference shares shall be treated as ECB. So this is this thing. From 2007, it started being treated as ECB. June 2007 is for debentures, and April 2007 is for preference shares. Before that, it were counted as FDI. So these are the various types of instruments wherein investment can be made under FDI.
What is the significance of this last sentence? Partially optionally convertible. How would looking at on a positive side, we understand it is saying, but where can we as chartered accountants take care that the client doesn't make error?
The term sheet, loan agreement itself will specify.
The agreement, subscription agreement or the share purchase agreement. It should
the board resolution and the AGM.
It should specifically say it is a compulsory convertible debenture.
Normally the terms are there on the instrument itself. Basically, issue CCD.
Yeah, on the instrument itself as well as very mostly.
In the SPA,
in case of big investment, there is generally a share purchase agreement or subscription agreement in place. So that needs to be specifically framed.
Coming to the dividend on preferentials point, what is when do you actually record the SBI PLR at the time of issue, at the time of declaration of the dividend? Because like you have mentioned, currently it is 14.75.
Correct. So ideally
17.7.
Ideally it should be at the time of issue, right?
But subsequently, if the PLR increases or decreases,
that is
at time of issue.
At the time of issue. I mean, you cannot keep it this thing.
You can just bring it from in ECB also. They say there is a limit for ECB also.
LIBOR.
They said
LIBOR
also they say at the time of issue what is the LIBOR plus certain percentage. Then if there is increase decrease, they do not.
You cannot.
So then we can get this analogy. Whenever you issue preference shares, at that time whatever will the PLR.
What about this put and call other conditions?
We have specifically dealt in a separate slide, so we can commit pricing. So whenever there is an FDI investment or probably transfer of shares, transfer of capital, which was an FDI, foreign direct investment, or transfer from resident to non-resident or non-resident to resident, such there are pricing guidelines to be complied. For listed securities, the pricing guidelines is as per the SEBI guidelines, as per prescribed SEBI guidelines. SEBI guidelines are basically, I mean, as per SEBI guidelines, it is basically average monthly rates of last 6 months, last 2 months, and
They change it to weighted average.
okay. So those are the, I mean, that is a specific formula which we need to calculate at the time of issuance, or at the time of transfer. As far as unlisted securities are concerned, at the price which worked out as per the internationally accepted pricing methodology on arm's length basis, duly certified by chartered accountant or SEBI registered merchant banker. Earlier it was DCF method, discounted cash flow method. This has been recently amended to an internationally accepted pricing methodology on arm's length basis. So, I mean, there is no any specific method. Practically, still people are following DCF only, because they are considering that as an internationally accepted method. But there, I mean, we can also follow other methods apart from DCF, if at all, it is matching
the experience of having other than DCF method.
But this has been recently introduced. I mean, not even
6 months.
for 6 months.
6 months. Yeah. And even
generally for manufacturing company or some startup company, there is a gestation period. So for next 3-4 years there will be no cash flow. But in the time you have 2-3 years of plant, because of asset base is high, so book value is considered as a fair value for that purpose. So there we are saying that DCF is not done because ABC reason, and book value is considered because of this reason. But that earlier, because before this amendment we had to go and tell RBI, especially authorized banker, because they will tick the box, DCF is not there. But now after this, book value will also be considered.
That's right.
But these
For the software companies now,
Because very
use the
difficult to
EBITDA margin.
project for at least for 4 years.
In
or
fact-
there is no.
In fact, recently when I'm doing one kind of valuation for a startup company,
Right.
over there I read through many of the articles.
Right.
Now what was said was that the DCF is not the correct methodology for many of the companies,
Right.
including startup companies.
Yes.
But there are other methods like excess earning method,
Right.
or for venture capital, for startup company it's venture capital method, or there are 2-3 more. So DCF is not pinpointed, and therefore it has become broader. So DCF at times was not feasible even for the investor to even chalk out for. Assumptions are so very important, which is never known as per the market. It's only on the growth opportunity. That's
So
right.
therefore 11UA was also subsequently amended after it was introduced to bring option of the SSC whether to do book value or a DC.
But that was only for-
But book value also will not be correct.
For
I
transfer
agree.
of share, it is the book value.
That is only for
267A says transfer of share.
for 2007B it has been done.
Only B where resident investor will invest for carbon inflation. There is an option book value or DCF. Non-resident in any case will be DCF. Now it will be
Correct. And book value is also a crude method. If you look at the venture capital method, just try googling, you get the methods now. Then venture capital method that focuses more on the growth opportunity of the company, the management team, and the reputation of the force behind it.
Right.
So accordingly, that's venture capital method. So that method has been, I think, now has been taken care of.
Even the market value method is one of the cases.
Correct.
You have to
Actually,
go
it is
through the
a
trail of the
elucidated price.
negotiation with the
Yeah,
investor. Well, there was a textile mill, defunct mill, and they prepared DCF method, the value comes to 0.
Justify the price.
And then we have gone into detail and we found that actually the intent was developing a real estate, and you have to do then the value, changing the
Say
figures.
internationally accepted.
So you have to be very practical in addressing
We
that.
were to do this valuation and weightage. So how do we say that what methodology is actually an international accepted?
For each industry, there are specific methods.
Laid
Now
down.
it's not laid down, it's just generally
Yeah.
accepted. Yeah.
No.
Yeah. Any investor who wants to invest or any dealing that happens, you go to say KPMG or anybody, they have a set of methods which is applied per se a sector. And then there are some general methods also like DCF. So, so intangibles where the methodology are not very clear. So that's when uncertainty comes into picture. But apart from intangible, it's quite clear. So which method has to be applied and which not. But largely it's DCF. By large it's DCF.
These pricing guidelines are applicable even for new issue or only for share transfer. Yeah.
There is one there is one condition wherein if you are subscribing to memorandum of association in a fresh issue, then you can invest at face value.
Par value.
At
Par value.
par value.
So at subscription level, I can invest at par value or I can invest at premium also.
Whatever is mentioned.
I think if it is premium, you need the certificate. If it's at par, you may
It
not
says
need
What's the
it.
valuation?
See, if it is more, there is not an issue at all.
That's my doubt. Because basically, if I do not want to justify the price and I invest at time of subscription, I can avoid the pricing guidelines altogether. Yeah, if I'm
You have to subscribe to the memorandum.
Yeah, but that should be at par only. That should be par only.
Always at par.
But now when you subscribe to the memorandum, you just give the number of shares you are subscribing.
But new company, if you issue at a premium, you will hit section 57.
No.
That's fine. That's a separate
No,
issue.
wow.
Such in,
As
see,
a small company.
it is face value.
Sorry?
It may be invested at face value.
It's
Or,
at face value.
yeah.
Maybe. I'm not.
But it says can be. So there is a possibility of premium also.
There is always a possibility because wherein a foreign investor is paying price to a resident, the criteria is that there should be a bare minimum. There is no criteria on the upward side. So if the minimum price is say 10 rupees, so when I am investing, as a non-resident investor, minimum what I should pay is 10. I can pay 20, I can pay 30, I can pay 100. But I should not pay less than that. So basically the pricing here is whenever a non-resident is paying, it is acting as a floor. It should not be beyond that. And whenever a resident is paying to a non-resident, it is acting as a cap. It should be more. It should not be more than that.
So here, I don't need to give any valuation if it is a subscription at face value.
Yeah. No
I don't
issue.
need to give
Whether
valuation.
face or not is there, but your question was
Supplement.
And then when I say that any internationally accepted pricing method, so after the RBI, is it possible that RBI may reject some of the method even though it is internationally accepted method, or is it that any valuation certificate which is obtained from valuation expert, as in?
Of course, it should be backed by a certificate, but
No, I'm just comparing.
Huh.
Say how we have in transfer pricing, you have to justify which particular method.
RBI may well come up with a
Yeah.
few queries, so you have to justify.
You have to have your basis. which
You have to
certified.
have a justification in place.
Define the basis, but the method. It is an internationally accepted method.
No, from as in my view, suppose it is justifying, but RBI says no, this is the other method is
Method. It's not the
better for this particular transaction.
That can always be.
That can.
It depends of opinion, but then what is generally accepted in a particular industry.
RBI may be against your method. You are saying, according to you, something is right. According to them, something is.
somebody does it Google, you
Huh.
can come and say, why don't you do this here? This is not.
Here.
They'll accept.
But if RBI can challenge your pricing,
I think valuation report should be more reasonable.
valuation reports.
It should be more speaking type of report.
It will be quite optimistic to say RBI won't
RBI can always challenge. RBI can always challenge.
No, RBI comes out with queries and you have to give convincing answers.
Yes, that's all.
If you convince them, then
That is the issue.
there is no further challenge. But
See,
that is
basically, in case of RBI, if you present, because most of the time they have observed that the valuation report is not giving sufficient details, one-liner valuation report. They generally ask for basis. That's
Good.
where the issue is.
So that the role of chartered accountant will be to look at the right valuation methods and accordingly certify. This
We
on
should
both
discuss out also which method you are not applying. So write about 5-6 methods, and write if you are not applying, looking at these circumstances, these facts, and accordingly I am applying this method.
That is the ideal way of, even under DCF method, the factoring thing was always needed to be discussed in the report. So we are not applying this factor, we are not applying this factor, we are not applying that is discounting rate. So if at all directly valuation is so and so much, that can always be challenged or questioned by RBI.
So it's something like elimination method, but
not only elimination, there could be even combination of methods. Value, you can use 2-3 methods and say this is
Weighted average also, and we give different weightage to different method and arrive at that is also permitted.
That's also.
They look at the reasonableness of your report at the end of the day.
Correct. So pricing.
Suppose there is a already FDI company and that Indian company is making losses. So now to grow the business, they need funds. The parent company is introducing more funds by way of paying to or right. So at that time also I need to do valuation. Now your Indian company is already making losses. So would it be proper to have a DCF and then get in money? Or now they are said internationally accepted, so I can make it on book value and then I get the money.
You can make it on book value. You can also
have it. We can take it on book value. Because see, book value would be very less, and getting a DCF again, you prepare the projection.
No, but you are calling funds for some operations, right?
Purpose.
So you can set pricing according that model. No?
See, if you have losses, carry forward losses, then your book value will be below face value, and under the company's act, whether you can issue below face value.
Then I can call the fresh, this also at face value. Still then I will require valuation from our
You
time.
draw down the future cash flows after.
You have to draw down the future
and
cash
how does the
flow.
business flow, and accordingly you have to decide.
It would be DCF.
It can be DCF.
Maybe alternative methods are possible.
Or it's as good as a startup company without any revenues. And then you go as per venture capital method or risk submission method and etc.
I'll give you an example of pharmaceutical company. They are developing two molecules. One failed. So the entire profit and loss is it. But there is a huge value in the second one. And that money is coming for the second one. Then you have to value, keeping in mind that and yes. Always remember the second. Not generally apply.
Shall we move ahead?
Yeah. Right issue. So in case of listed securities, at the price determined by the company, and in case of unlisted securities, the price at which we are issuing should not be less than the price issued to resident shareholders. So it should not be a case wherein resident is paying 10 and NR is paying less than 10. It should be at least the price which is paid by the resident shareholders. Price needs to be determined upfront at the time of issue, and pricing norms are not applicable wherein there are transfer from one resident to non-resident to another non-resident. Basically, the logic which I could draw here is because there is no forex implication as far as India is concerned, as far as the Indian thing is concerned. So the pricing is not required wherein there are transfer between two non-residents. And as discussed, in case of subscription to MOI, pricing can be at face value, subject to compliance with the Companies Act. Partly paid up shares. So partly paid up shares, the partly paid up shares and warrants have been recent.
The question is right issue. If right now if the shareholders, both the shareholders are non-resident,
That is a little this thing. I mean, in case of a 100% owned subsidiary.
exactly 100%. It is JV, two different companies will be coming and forming up.
Correct.
In that case, there is no resident shareholder.
There is no
How can
resident.
then again you need to do to RBI and ask them, or you do it on the safer side, you can have a valuation done and then you for right issue.
For right issue, valuation need not be done. Na? Then what is the meaning of right issue?
Then how will you find out at what
shares? You only the existing shareholder has got a right. That is they already new shares.
Yes.
And it should be required.
because if it was
Allotting
everything,
to both resident and non-resident, in that case, then probably they are saying that the value should not be not conditional, saying not less than the price.
so in fact, if I am going to issue shares, how would I determine the price that I am issuing to resident also?
That is
Then also you will be working out.
that is an open issue wherein the entire shareholding is held by non-residents. So how to determine the price?
What is anyone has come practically and how they have done it? We can have a proposal can what practically people do if they are 100% holding.
We can write the shares.
Shell India.
In case of 100%,
In case of 100% foreign investment,
In right issue, what can be?
what about right issue?
pricing,
Valuation getting to be done.
Valuation.
Yeah, maybe an inspector. Even for 100%
Then you issue
but
the
she
share.
has residents and non-residents. Like coming into the rights issue, there cannot be differential.
Yeah, because they say issue of shares, so you are issuing the
differential
shares.
pricing.
See, whether right or whatever, preferential or whatever name you give, actually you are issuing the shares, so the valuation
See, again the thing is that there is no, I mean, even when there is 100% shareholding, there is a right issue being made. So
further
shares are issued. So it is a right issue only. But I mean, there is no meaning of the valuation, because the thing is that the non-residents are the only shareholders. So there is no suffering, or there is no compromises being made on part of the resident shareholders. That is the income tax thing.
Foreign exchange, if you don't do valuation, they may bring in less money.
See, first, while issuing, you have to comply with this thing. But while there is a right issue, see, in case of unlisted share, the price issued should not be less than the price paid by the resident shareholders. Basically, this is there should not be a compromise on the part of the resident shareholders as far as their shareholding is concerned. So if all the shareholders are non-residents, RBI should not be concerned. Nah? They may well do a bonus issue.
If you look at the case of Shell India in the income tax, they issued shares to the subsidiary, and the income tax has taken that it was a lower value. There is no FEMA notice to this entity. That means it can be permitted.
They've done a valuation.
They've done a valuation. But what I am saying,
it is not just like that. They've done a valuation. This was a scientific valuation according to them.
Yes.
Income tax was not different.
No, that's what I am saying. That had been the case, the RBI should have also issued them the notice that it was done under value.
How you value? If your shareholder approve your valuation,
The shareholder is himself to whom you are issuing. So he will approve any value.
Suppose the value of the company is 500 rupees and is a 100% subsidiary. You are issuing shares at 50 rupees.
Correct.
So there is a foreign exchange out not coming into the.
See, if you are issuing shares.
So that here they are trying to protect the foreign exchange.
It has to be done at a fair value.
Agreed. So if there is a resident shareholder as well in place.
See, if there is a resident shareholder, then there cannot be differential pricing in the right side.
So in case if there is resident shareholder in place, then in that case I can issue at 50. But if it is only for investment, the 50 is not.
Then what happens is, but even that 50 has to have a valuation. See, even that 50 has to have a valuation. When you even issue a rights issue, go to the whoever it is, to get the approval of mutual authority, they'll see how you valued it, right?
See, valuation is basically
it's an additional condition. Not as in the price issued to resident shareholders. It's an additional condition. You still need to follow the pricing guidelines.
No. According to me, so it should be again minimum.
Your floor price. Floor price is as per valuation. But again, it is increased if you are charging the resident shareholder higher than the floor price.
But then what is right issue? It is always generally right issue are at the prices which is lower than the market value.
In case of listed securities.
Because we have only been even for unlisted it should be such a case.
Unlisted only determined. There is no market value.
There is no market. See, the only reason is that there is no dilution of shareholding of the resident shareholder.
You are not control at all.
FEMA would primarily look at control from non-external agency angle or outside country angle. So protecting the resources, which is foreign exchange, would be the primary criteria.
Correct.
So pricing at that time would always get influenced.
See, bonus is allowed.
Bonus is allowed.
So
bonus does not determine anything because 5 शेयर का 15 शेयर किया है अल्टीमेटली फर्क क्या पड़ता है बिकॉज रिजर्व्स कम रहा
वही मैं बोल रहा हूँ कि फॉरेन जो शेयरहोल्डर जो नॉन रेसिडेंट का है वही डाइल्यूट हो रहा है कुछ फर्क नहीं पड़ रहा है
basically you are allotting further shares to a non-resident.
Correct.
And he is not paying the due value of the shares. Country is losing.
See, 500 rupees value, if you are going to issue 100 rupees, he is getting a share worth 500 and 100.
Country is not losing.
Country is not losing.
Your market cap is 1000 crore, unlisted, okay, and you are issuing shares of 100 crore. Let's say at a price of 5 rupees. Because the total number of shares value will get diluted. He is the owner, so net worth remains the same. So ultimately, number of shares you will be holding more.
I will not agree on that.
Because whatever money required for business,
because you are looking at very.
Say, let's say you have 100 rupees capital.
What you are saying? There are
the moment you bring it 125,
there are 15 non-resident
the value comes
shareholders
down of the original share also, like in the bonus.
No, let's look at, you are saying that there is only one shareholder. I am saying there are 15 shareholders.
Let's bargain and go ahead.
Yeah, that's bargain. Yeah.
Without
But this is a very
Legally.
good point. Basically, in case of 100% subsidiary, whether these pricing conditions apply or not.
If there is a 100% subsidy, the typical question with the subsidiary here is to raise the money. So instead of invoicing, if they do a rights issue without having any valuations applicable, so that could be another way to get in the money.
That's a basic.
If they were
You're getting the money.
so instead of invoicing, if they go ahead with this, so will it be allowed? That will be another way to get in the money.
My view is the pricing conditions will apply, and this is an additional condition. But the resident shareholder, if he's being paid, if he's paying higher value, your floor price goes up.
No, even in this thing, regulation 6, there is no mention that you need to comply with a specific pricing guidelines. The only conditions are, in case of listed company, it should be as the price determined by the company, and in case of a unlisted company, it should be at a price which is not less than the price paid by the resident shareholders. So there is nothing specifically written wherein you have to comply with the pricing guideline. And the only, according to me, as far as my logic goes, the only restriction here is that the share capital or the shareholding of the resident shareholder should not get unnecessarily diluted by issuing at a price which is less than by issuing at a lesser price to the non-residents. So that is the only criteria, according to me. Because
Rights issue, I say.
as far as rights issue is
There's no
concerned.
dilution. It will be like basically both.
No, same.
Might be a dilution also. If one accepts, other does not.
Not a part. Otherwise, if you are not taking the same proportion, there's no
There
dilution.
is no.
There is no dilution, but there should not be an unnecessary loss as far as the resident shareholders are concerned. They should not pay a price which is more than the price paid by the NRs, non-residents. So that is the restriction given here.
We will
Let's
escalate to.
escalate.
So in this
I have
question
written
also there is a floor price maintained, but the floor price is determined as if what is the price paid to residents.
Is it fair value? Whatever price the resident shareholder is paying, is it fair value?
Very, very.
Back to square root.
No, so even if it's not a 100% subsidy, so otherwise also anyone can take benefit of this. That there's just one resident shareholder, rest all are non-resident. I issue, just for the sake of it, I issue at say price 10, but fair value is suppose 100.
Money will flow exchange abroad.
We get it.
Fair value to
So this is not only in case of 100% thing. Otherwise also this can be.
Next is partly paid up shares and warrants. These have been specifically allowed in July 2007. Earlier warrants were there in FDI policy under approval route, but under RBI route there is no condition as far as the approval is concerned. So probably the one view is that since there is nothing specifically mentioned in the RBI, the approval is not required, but still it would be advisable to practically check before doing any transaction. And the conditions here are that there should be 25% of the total consideration should be received upfront. Even in case of partly paid up shares, the first call or the upfront payment should at least be 25% of the total consideration, including share premium. And even in case of warrants, the upfront payment should be 25%. As far as partly paid up shares are concerned, the balance amount should be brought in within 12 months. As far as partly paid up shares are concerned, it is 12 months. But in case the issue size exceeds 500 crores, time period to be extended beyond 12 months, subject to monitoring conditions. I mean, so the leeway has been provided that it might be more than 12 months in case of very big investments. But then the cap has not been placed. I mean, there is nothing, okay, it should be 18 months or it should be 24 months. It is just saying that it can be beyond 12 months. Warrants, pricing of the warrants and the conversion formula to be determined upfront. So conversion formula basically should be determined upfront. Conversion formula should always be based on the equity pricing, and in such a way that it should not be less than the current fair market value of the equity.
The which brings us back to the
which again brings back to the thing. Again, 25% of the consideration should be received upfront, and the balance may be received within a period of 18 months. And while the another poser here is at the time of conversion of warrants into shares, it should not be lower than the fair market value worked at the time of issue of warrants. Say I am issuing warrants today. The market value of the equity shares is 10 rupees. 2 years down the line, the warrants are getting converted into equity. So the conversion should not be such that the value of the equity is less than 10 rupees, which is at the time of issue of warrants. So there might be a case. This is the case wherein there is a conversion formula being placed. The conversion formula is this: the current market price will be taken into consideration. So if 2 years down the line the current market price is less than what was there at the time of issue of warrants, so that is not possible. At least the price which was at the time of issue should be maintained.
Can we have an example of a formula? What are you saying? Conversion formula. What is the conversion formula you're talking about?
Okay. Say for example, I am issuing 10 warrants of price is 200 rupees.
Today.
Today.
So the investor pays.
I am 200 into 10, 2000 rupees. And the price of the equity today is say for example 200 rupees. Okay. So the conversion is 1:1 as of now. But the formula which I have inserted is at the time of conversion it will be converted into the fair market value as on that date.
So then what happens?
So 2 years down the line, say I have 2000 rupees is the capital. If the pricing of the equity at that time is say for example 400 rupees, so it will be 5 equity shares against 10 warrants. Okay, so the pricing is more than is 200, which is more than 100, which was at the time of issue, which is fine. Say for example if it is 50, so it will be 20 warrants. So now that is not 20 shares. Sorry. So now that will not be permitted.
So
at least 10 shares.
How much shares you can get for a warrant?
Yes. Correct. So at least
it could be a low number of shares.
It could be lower number of shares, but not of course more. So the price on conversion should not be lower than the fair market value worked out at the time of issue. Okay. No time limit specified beyond wherein there is an extension of beyond 12 months. So that has been. And even while sectoral caps, even while issuance of warrants, it should be taken into consideration. If it is converted, it should not exceed the sectoral caps.
Where do these warrants get used?
Where do these
warrants get used?
Practically, I have not come across any.
Where do these warrants get used?
For the object of the issue.
No, what I mean is like, when do you choose to issue a warrant rather than an equity?
When you do something and there's something contingent, that okay, this project requires 100 crore and upfront is 25 crore and the balance upon let's say extra approval comes, then you might require 100, then where do you go? So for the second phase basically this build, so that you cannot go back.
Yeah, if the contingency doesn't materialize,
then
refund the warrant.
No, it is forfeited normally.
Forfeited.
Normally forfeited.
Or you get lesser number
But you
of
get an
shares.
option.
Or you get lesser number of shares.
It's like SEBI warrants, promoters now, when the issue price is this and in the next 18 months you will be converting, subject to the favorable condition. Then SEBI has put condition that 25% upfront and it will be forfeited, not refundable.
Next is pricing guidelines for convertible instruments. Convertible instruments means CCPS or CCDs. Convertible preference, compulsory convertible preference shares or compulsory convertible debentures.
So, so in the typical balance sheet, where would the warrants be a part of?
Below share capital.
Below share capital. Below share
Not
capital.
as part of share capital. It is not share capital.
It is not a share capital.
Below share capital.
Below
It's a
share
separate
below
note
share
you
capital.
put share warrant, and you also calculate diluted EPS if it is converted.
And what rate? And what rate?
All terms are defined now. Right.
The dividend rate is being attached, is defined, and also the conversion formula. and probably
number
even
of shares to be issued has to be predefined.
Predefined.
So that is the potential dilution of that number of shares.
If you predefine, like let's say
Let's say I'm going to issue
one warrant is one share, as the example.
Yeah, at let's say 100 rupees. So 25 you pay it today.
Yeah, but ultimately let us say it's going to get converted at, let's say, for one warrant, for two warrants, one share.
No, it cannot be. You can't change.
Maybe we kept no, but the valuation is low tomorrow.
No. So pricing is fixed today. You cannot change it. In the warrant, the pricing, the number of warrant shares, everything is.
The conversion is fixed. So there might be a case, wherein I am issuing, I am defining one share against one warrant.
Otherwise, how will you arrive at 25 consideration as
But that formula 1:1 may not go with the current pricing. So, for example, I am issuing, say for example, one warrant for ₹100, and the pricing of the equity share is 200. Probably I might if the formula or if the condition attached, I don't know whether it is possible or not. Okay, if the condition attached is one share against one warrant, even though the pricing is not matching, the equity share valuation is 200 and the warrant valuation is 100.
What's the condition today?
There is a condition. So 2 years down the line,
not 2 years, no? But it has to be finished within 12 months.
No, it is.
Or warrant 18 months.
warrant
instrument is very simple. You design what you want. I'll tell you, the instrument is very simple. You design what you want. Whether you want to attach one warrant with 3 shares or 2 shares or whatever consideration receivable on the shares will be 25%, and that has to be paid along with the warrant. This is that way decided.
Or even when you are
25% is an advance, and then 75% will come at the time of conversion.
25% is what as per this guidelines.
As per the guideline, at least 25%.
At least 25. And the formula which you are, say for example, आपको एक warrant के सामने एक share मिलेगा, एक warrant के सामने 2 share मिलेगा. So that is a decision which is left to the company. Okay, so that has to be in line with the pricing. If that doesn't go with
today,
as on today.
But at the time of conversion, if it
Same
is
price.
favoring the warrant holder,
It should not.
What he is saying is everything is crystallized on day one.
Day one.
Instead
Only
of
payment terms.
at the time of conversion.
So at the time of conversion,
No, there is no ambiguity only. It is determined.
Normally, I'll tell you, warrants are never get converted. They give you right to subscribe to a shares at a particular price.
Okay.
In real terms.
Okay.
Because otherwise you can't forfeit.
Okay. I think further discussion will only get more confused. थोड़ा पढ़ के आएगा next time. You take one warrant, sir.
If it is not FDI and if it is non-repeatable, no valuation is required. As per Schedule 4, no valuation.
Non-repeatable तो
guidelines don't apply only Schedule 4.
But though non-repeatable आप कर सकते हो कि नहीं, that we need to check in other schedules whether it is possible for a foreign investor.
Because foreign investor cannot do all that.
NRI
Only NRI. Not foreign investor.
Not foreign, only NRI.
If you have failed to file FCGPR and all that, you have failed to do, then you say it is non-repeatable.
But will RBI accept? Will RBI accept?
Only if you are an NRI. If you are a foreign company, then you can. And even if you are doing that, there are certain compliances in place to be done in place. If you are not, if in FDI it is FCGPR, then in non-repatriation,
In Schedule 4 there is no reporting.
No
reporting. इसके लिए अभी 6 days अभी join किया हमने.
Reporting, no valuation.
So convertible instruments, there is no upfront determining of a fixed conversion price. Upfront कुछ determine, there is no requirement of any upfront determination of fixed conversion price. Again, a conversion formula can be determined. Sorry? Conversion formula, not the price. Conversion formula to be determined upfront, not the price. And at the time of conversion, again, the price on conversion should not be lower than the fair value worked out at the time of issue of convertible instruments. Same logic as discussed in warrants. And pricing guidelines are applicable at the time of investment as well as exit. at the time of investment by non-resident, the pricing determined is the floor, and at the time of exit it is capped. It should not be more than the price.
So when I issue convertible instruments or warrants, at the time of issue itself I'll have to determine two prices. One is my issue price and the
No,
second
I tell you the key difference between the convertible and the warrant. Warrant, the pricing has been decided. When you come to the convertible instrument, the formula has been decided.
And again, see, even in case warrant, if the pricing is decided, that pricing may not be in tandem with the FEMA pricing.
Yes.
That pricing may be as per SEBI pricing. So you have to be as per the FEMA pricing. As far as the compliances here or the conversion formula here is are discussed, you have to comply with the FEMA pricing and not. I mean,
it's a fair value. So formula, what happens? Let's say you are investing and your equity conversion will happen linked to the EBITDA, and if a performance is not happening, then it can be. But minimum it should be at today's price. Let's say you value a company at today's price at 100 rupees, and your projection given on the DCF method by him gives you a value of 300 rupees. And tomorrow, if he doesn't perform, the value comes to 200. So they link to EBITDA. This is however subject to the fair value which is applicable today. So that is formula based. Convertible instrument is always formula based, linked to certain parameters very clearly defined. Only punch in numbers and the derivation is the number.
I have to determine to satisfy third condition.
Upfront.
I have to determine the fair value at the
time of issue of the
equity share also.
Yes,
today.
At the time
today. Minimum
So
floor
there
price.
will be two prices which I have to determine.
No, there is one price, two values.
See, generally pricing for
price.
CCPs and CCTs is, I mean, it is generally 100 rupees, 200 rupees, 1000 rupees.
So
that has nothing to do with pricing. The conversion formula has something to do with pricing. Say for example, right now you are issuing shares. Right now you are issuing CCPS for rupees 1000.
So this 1000 need not be as per the internationally accepted pricing.
No. 1000 is this thing. The conversion formula, because finally it will get converted into equity. So that conversion should be at the minimum price of equity which was at the time of issuance.
It can be higher depending upon that.
So roughly, suppose 1000 is the CCPS and the value of equity share is 200 rupees. As of today, for that 1000 you get 5 shares.
50. Sorry, 5.
200 as of today. I am issuing for 1000 and 200 the value of share. So if I convert it today, I will get 5 shares for 1000.
Yes.
Then after 18 months or whatever period, suppose the value becomes, instead of 200, 100, I cannot give him 10 shares.
No. It is either.
That's all. But instead of 200, if it becomes 400,
okay,
I can give him 2.5.
Correct.
Alright.
200.
So that is a floor price.
So minimum 5 shares or less, not more than that.
Exactly. That's it.
This is a very popular instrument used by private equity for real estate. For real estate, I'm saying that take out money to save dividends.
You see, at the time of exit again, I need to at the time of exit of CCD, where I convert into equity. Again, I need to value what is my value of my equity at that time.
No, see, generally, आप जब भी exit करोगे, तभी conversion formula रहेगा. So that conversion formula you apply. So if you are getting 5 shares or less, it should be fine. If you are getting more than 5 shares, as discussed, so it is not acceptable.
So this conversion formula, you are saying 5 shares. Now that 5 shares is determined around as per fair value.
Yeah. See, we just discussed. If I am issuing something, I am issuing one CCPS for 1000 rupees, and the value of the equity share is rupees 200.
That has to be 5 shares. You are saying I will give you 4 shares for every CCPS. 4 shares.
5 shares.
4 shares, I am saying.
4 shares for every CCPS.
That is the conversion formula which is agreed to. Now that has to be as per the fair valuation.
Conversion formula except from the price. Number of shares is a resultant.
But the thing is that it should.
Okay. How many?
On what basis you will price it, and then accordingly the number of shares have been decided.
Price the CCPS.
Equity. See, first you will value equity. Then you will set a conversion formula.
To find out the conversion formula, you need to do valuation. To find out the conversion formula, you need to value right now today or equity based on whatever method.
Number or price, both are required as a factor to convert.
Yeah. See, there might be a case wherein I am issuing something for rupees 1000. Okay. So the investor will agree, the company will agree that 2 years down the line when it will convert, I will convert at the fair market value which is applicable on that date.
For the equity share.
I mean, this is a conversion formula. This is a commercial which is being agreed between the investor and the company. Okay. So I am issuing a preference shares at rupees 1000, and I am assuring him that at the time of conversion, 2 years down the line, I will get you converted at the fair market value as on that date.
Okay.
So here the company probably is very optimistic कि तभी उसका प्राइस ज्यादा रहेगा, because उसको less number of shares issue करना पड़ेगा.
But company will say so many shares at the price.
No, I will issue. No, see, the conversion formula is very this thing. The conversion formula can be in 3 shares in case of against 1 equity, or the conversion formula can also be the conversion will be done at the fair market value as on that date. So this is also a conversion formula.
Well, Marty, you have to define your formula.
Let's take example,
You have to define your formula. Whether it could be a book value or
I think it is somewhat similar to warrant, and we will park it for the next meeting. Whether you approve application.
Chintan, as I understand, CCPS will collect an X amount, and that X amount will be transferred to the capital divided by the formula. So it can't be 1:3 or
number of shares are derived from the valuation,
Yes.
and valuation formula is decided today. However, there is a cap that no number of shares will be issued more than that. It is on the
That 200 rupees which you are valuing is as per FEMA.
Correct.
Is as per FEMA.
Yes, as per FEMA. Yes. So
that means your floor price is 200.
Yes, and the commercials may be less or more, but at least it's
Even
not
more, no problem.
No,
Because
yes,
let's
it should not.
have
Yes,
200.
correct.
At that time, the valuation may be 1,000 crore, but if you arrive at
See,
a
because the
formula,
commercial valuation or the understanding between this thing may be different from FEMA. Yes, sir.
So if
So tell me.
conversion formula and this floor price is contradicting. Suppose if I am going by conversion formula, my price is lower than my floor price. So I cannot.
So you cannot do that.
You can have to issue a floor.
Yes.
See,
No, then if I issue at floor price, then I am violating with my conversion formula.
So that is
because the conversion formula writes subject to floor price, subject to minimum of floor price.
that is nothing to do with the law. Na? That is a commercial agreement between the parties.
The FEMA says 200 के नीचे नहीं जाना.
नहीं जाने. हाँ.
You maintain the agreement.
100 में 150 है तो तुम 200 में इश्यू करो.
हाँ, but conversion formula.
But formula में लिखते हैं ना मैडम comma मार के, however subject to minimum price of
work out
business.
नहीं हुआ just to comply with this floor price, then I cannot do anything.
No,
See,
no,
conversion-
you have to issue compulsorily.
Below that, the floor price is determined. 200 is fixed, whether it will go below or not.
Yeah, so you have to issue at
You have
200,
to issue at 200.
where the price may be 100.
So that's a risk he's taking.
Yeah.
Yes.
Floor price is
That's a
the
risk the
base price.
investor is taking.
That the risk the investor is taking, or
Already he has taken if he is investing today.
see, the thing is that the actual investment is as on date.
Right.
So the pricing should be also as on date.
tell me, if there are already CCPs issued by the company before this investment, will for the purpose of valuation calculation, we will take CCP as a fully diluted basis? We will take only
Yes,
number of
yes,
shares?
it is
It
fully
is
diluted.
equivalent to
Equity.
Yes,
Including your EPS.
And if there are CCDs, then
Again diluted.
diluted. 1:1 or whatever ratio is
Whatever
there.
is mentioned.
Whatever is-
Whatever is the term.
You move your conversion formula to be different.
Let's go
However,
ahead.
price on conversion should not be low.
We are
So,
way
if
behind.
the conversion formula gives you a different price, lower. So they have to provide.
Yeah. Consideration for issue of shares. Now these are the various, probably inward remittance through normal banking channel. These are the ways through which foreign investment can flow. Money will flow into India while investing into FDI. So inward remittance through normal banking channels, NRE or FCNR account, probably this is for NRIs, and the others are for non-cash consideration, conversion of ECBs, lump sum technical fees, import payables between corporation, etc. into share swap. So these are the various forms of consideration, and there is one debit to non-interest bearing escrow account in Indian rupees. Now this escrow account is something which has been which can be opened by a foreign investor in India for the purpose of foreign direct investment. So there are conditions attached to it. They can open an Indian account, Indian escrow account, wherein through which they can do foreign direct investment, and that is one of the prime the objective was in case of takeover code. For example, a foreign investor is investing, has acquired control into India, of some shares in of an
Open
Indian
offer.
company,
Open
offer. So for that thing, this is the escrow account is of prime main the reason.
That is a mandatory necessity.
Mandatory.
Unless you bring in, you cannot proceed on.
Correct.
And
And
give open offer.
if the shares or CCDs are not issued within 180 days of the receipt, then the amount needs to be refunded. So it is mandatory that you issue shares within 180 days from the date of receipt. In case of the technical fees, royalty, or even in case of the other thing, there have been dates. For example, in case of import payable, or in case of technical, the date on which they become due will be the date from which 180 days will be counted. In case of pre-incorporation expenses, the date of incorporation of the company will be counted for the purpose of 180 days.
So this same so in case I am sending some remittance through the banking channel, so obviously sometimes there is an extra amount that comes in because of the conversion factor.
Correct.
So I remember that also has to be remitted back within 180. But if it has not, then what?
Then you have to take sanction of RBI.
You have to, if it is beyond 180 days, you have to take RBI permission.
If I want to send it back, if I don't want to send it back, then
You have mandatory.
You have to-
Otherwise, company law will get affected.
You cannot.
You have to mandatorily.
Why would you have a difference? Because the exchange.
Exchange rate, yeah.
Is minor.
Minor.
It will be small, but
Yes.
If it is 100, 500 rupees नहीं होता है. Typically when you have got 10 lakh shares and 2 crores rupees, then it will be 5-7 lakh rupees.
The legitimate due has specifically not been defined.
That is where you
What has been
are.
said here is that any payment out of India which does not require RBI permission or a central government permission is a legitimate due, which does not require any approval. So against that you can issue it. If it requires any permission or approval, you cannot issue.
Because your terms of issue does not have premium. So you have to fudge everything. It's too risky. It's too risky.
or take it as a loan.
Sorry?
No, it is
No, you cannot
permitted.
force it also.
I only want to say it is permitted to repatriate
It
back.
has to go.
It is.
Otherwise,
You have to
it is
repatriate.
problem.
You have to repatriate back. Na? You cannot use. And even taking into this 180 days now, because of the Companies Act 2013, the amount is just 60 days, and that too in a separate escrow account. So there is no you cannot utilize that fund for any other purposes. Either 60 days into a separate escrow account or refund it as per Companies Act. So, and the penalties are heavy under Companies Act. It is 1 CR and so on. So 180 days practically now is not relevant. 60 days is probably this thing. This is a typical fund structure. I mean, a private equity fund structure. Generally, the private equity is this is as far as FDI is concerned. The private equity also invests through FI and FPCI. Generally, the private equity funds or the investors are basically into various jurisdictions. They will set up a SPV in a tax efficient jurisdiction. Say for example Mauritius, Cyprus, Singapore, through which they will further invest into India. And I mean this has nothing to do with FDI and all, but this is a typical fund structure. How does it work? There is an Indian advisory company which does all the research work, which then sends recommendations to the Mauritius manager or the US manager, which in turn advises SPV. So this is a typical fund structure as far as FDI is concerned.
Advise Indian advisory company or investment management and FDI. It's having a problem in FI or.
He's talking of FPs. This is typical for PEs.
This
This may not be for FDI. Sorry.
It's for FDI. We would need an Indian advisory company or investment manager. So at one time, bullet payment to the company, Indian company.
Correct, but then there is a team required in India for this research work.
Asset management company. SEBI has formulated now 50 crore minimum capital. Previously 5 crore.
FPI, foreign
So now they made it 50 crore. Become now non-MBA.
now these are the various non-cash considerations. One is conversion of ECB into shares or CCPS. Activity should be covered under automatic route or under if it is under government route, the approval has already been obtained. So you can convert ECB into shares or CCPS. See again here, it is just shares and CCPS. There is no CCDs. So either, and conversion facility is available for ECBs availed under automatic or government route, whether due for payment or not. Practically, I have not done this ECB thing. In case anyone has done this ECB thing, I mean, we would like to know what is it conversion facilities available for ECBs. This is a specific condition set out in the schedule, wherein it says conversion facilities available for ECBs availed under automatic or government route. Is there any?
We will cover in the next time when ECB.
While doing ECBs. Okay.
But I think what it just means is you are permitted to convert it. That is all it means.
But then there will be some conditions or
Pricing guidelines. There are conversion pricing.
So this probably can be more clarity while we are doing ECBs. Issue of equity against lump sum technical know-how royalty under general permission. So if there is any technical know-how fees or royalty payable, there is no RBI FIPB or RBI permission is required. You can issue shares subject to pricing guidelines again. Issue of equity shares against import of capital goods under government route. So you need to comply with the Indian laws, custom laws and all. I mean the import should be as per the laws. One of the conditions is there should be an independent valuation done. This probably, and the application for conversion shall be made within 180 days from the date of shipment of the goods. So again that 180 days thing comes into picture. Okay, 180 days. Okay, so these are the three conditions, but these need to be done in under this thing, under government.
If royalty is payable, you can convert it at reasonable price.
At the pricing you have to meet.
Pricing guidelines.
Pricing
but no permissions etc. required.
No permissions. FCGPR वगैरह file करना पड़ेगा. The normal compliances which you are for FCGPR and all that needs to be filed with the RBI along with the valuation report.
But also 15 CA
15 CB is only for remittance. There is no remittance here.
We are converting into shares.
Under 195 doesn't talk about remittance. So any payment to a non-resident file these prescribed forms.
So you are giving
income to
kind.
non-resident. No?
Yeah.
Instead of giving royalty, you are giving shares.
Like 15 CA.
15 CA तो नहीं लगेगा. CB शायद लगेगा. CA is a practical thing which is required by a banker.
Both will be required. And whatever you will convert will be net of TDS.
Net of tax, yes. It will be net of tax.
So your book entry it will itself be net. Please understand, when you are making a book entry, it will always be net because there is a next liability which has to be discharged.
Fair enough.
So it will always be net.
Above application to be accompanied by special resolution of the company and the approval will be subject to RBI pricing guidelines and appropriate tax clearance. So the niche,
so RBI pricing guidelines are to be followed.
Of course,
RBI need not be approached for pre-sanction.
No, the pricing guideline needs to be followed. And issue of shares against pre-operative, pre-incorporation expenses under government fee. Again here, three conditions: submission of FIRC. FIRC is generally a condition for every this thing. While wherein funds and payments have been received from the promoters. So FIRC for those payments needs to be submitted to the while obtaining approval. Valuation and certification of the pre-incorporation operating expenses by the statutory auditor. An application for capitalization should be made within 180 days from the date of incorporation. So within 180 days of the incorporation, you have to make an application for the conversion. And everything above should be within entry route, sectoral caps and pricing guidelines. Everything is always subject to a sectoral cap and a pricing guideline and the other conditions specified in the annexure.
Coming back to that query that you'll have to go back to the RBI, it will be a yes if it is under the approval route, right?
If it is under government route, it will be FIPB. It is not RBI. It will be FIPB, Foreign Investment Promotion Board.
Okay.
And if it is under automatic route, you need to you can issue the shares and make the relevant compliances. FCGPR you need to file with the RBI. That's it. So basically there are two types of approval. No? One is government approval and one is RBI approval. Government approval is needed for the sector thing, sector caps, sector conditionalities, and RBI approval is needed for generally the foreign exchange this thing, pricing, deferment of consideration, etc. etc. Share swap. Issue of shares against other shares. So here again approval, FIPB approval will be required, and in this case both inbound as well as outbound regulation will apply, because the company is also simultaneously investing in an offshore company. So again outbound regulations we need to comply with, as well as the inbound regulation, and there should be a merchant banker certificate, merchant banker registered valuation certificate. Here the chartered accountants are not this thing allowed, or an investment banker outside India for the valuation of shares. Issue of shares against any other funds payable, remittance of which does not require any permission. Now this comes to your thing, wherein a recent circular has been in the recent circular RBI has allowed to issue shares against any legitimate dues payable by the Indian company to the foreign party. So wherein any amount is payable by the Indian company to the offshore, which does not specifically require any permission from RBI or central government. So those are the free payments which can be made offshore. Against those payments you can issue shares.
So this doesn't require the 180 days limit.
This doesn't require 180 days limit. There is nothing been specified here.
What are you talking about? 180 days. It will logically apply. It will logically apply.
Even at my due date, beyond due date, it may be not allowed.
Logically.
Probably from the date they become due.
Due, yeah.
I mean, there is nothing specifically said in the notification, but the logic. An issue of shares by SEZs against import of capital goods. Normal companies you need to do under approval route, but for SEZs you can do under automatic route. However, valuation from the relevant prescribed authority, custom officials or the committee consisting of development commissioner need to be there in place while issuing shares.
For capital goods there is a restriction on issue of shares.
For capital goods by SEZ there is
no other than SEZ.
So there is government route.
For royalty there is no restriction.
No, royalty there is no restriction.
For goods there is no restriction. There is only capital goods there is restriction.
I mean, goods probably will come under any other fund payable, the remittance of which does not require any permission. So this is a very open
because capital goods also, when you have to make remittance, you
but
don't
then
need
they have specifically set out this thing, specifically made it under the government route. And of course, appropriate tax clearance we need to have in place before issuing any shares. General permission have been granted to the following things. I mean, there is no RBI or government approval required in case of following things: rights shares and bonus shares. Rights, additional rights, bonus issues can be made under general permission. However, it should not amount to breach of any sectoral caps or guidelines. So if there is already an existing investment, you might issue rights shares, you can issue bonus shares on that. However, they should be within the sectoral caps. Also, they should be compliant with the other laws in place, Companies Act or SEBI, etc. etc.
So all filings will be required in this.
Filings, everything is
valuation,
required.
Pricing guidance, everything has to be made.
Yes. Okay. So FCGPR is required for any issue of shares. Any issue, be it right, be it bonus, be it ESOP.
What about subscription shares? What about subscription shares?
Even that you need to this thing. Issue of an acquisition of shares after merger or amalgamation or merger. Here again, generally the amalgamation, mergers and all are generally governed by High Court orders. So there is no specific condition as to pricing in the regulations. Probably the pricing will be taken care by the High Court order. So that should not be an issue.
The share price issue, the valuation will to attach along with that. you have to issue, you have to attach the swap ratio valuation report.
Huh.
So that you have to attach along with this FCGPA.
Yes, that you have to attach, and probably even you need to submit to the RBI the shareholding before the event and after the event. And also you need to submit. And generally governed by the High Court order, and again it should be within the sectoral caps, and it should not be any prohibited activity. ESOP scheme, again the employee stock option scheme should be as per the SEBI regulation in case of listed companies, and as per the Companies Act or the company's rules in case of listed companies, in case of unlisted companies, and other reporting requirements should be done as per FEMA, FCGPR and all. However, the catch here is that the face value, the shares allotted to the non-resident employees under this scheme should not exceed 5% of the paid up capital of the issuing company in case of listed companies. So in case of listed companies, the cap is 5% of the paid up capital. You cannot issue more than 5% of the paid up capital to the non-resident employees. This is a restriction placed here.
We'll stop over here. This is a new. Will not leave it so easily.
What is the ESOP thing? Can you just repeat the last one?
ESOP में the shares issued under employee stock option scheme to the non-resident employees should not exceed 5% of the paid up capital
of the company.
Of the company in case of listed companies. This is only in case of listed companies.
Unless there is no such condition.
There is no such condition. Sorry? हाँ नहीं लेता हूँ.
स्पीकर है वो लास्ट में ठंडा खाता है
हमारे कंफर्म करो बोले ये और एक पच्चीस ये हमारे हाइजिंग ऑफिस ले
1220
अब ये बात एक
बेउ જોઈએ છે બેમાં જે બેउ નેક્સ્ટ મંથમાં બે છે મંથલી ટુ મંથ 12th and 21st subject to
લેવા માટે
subject
every month it will be by fortnight.
we'll try to
Continuation.
It will depend upon the managing council meeting. So we're tentatively fixing 12th and 21st. We'll confirm it within a day or two. Send in notice. You're okay with that?
On
12th of Jan.
12th
Monday.
of Jan is fine. Yeah.
Monday. 13th, 14th there is a site flying in 15th, 16th, 17th is booked with the council meeting.
21st is again a
21st is very
Then holidays.
So can we not have Wednesday before 12?
It will be two people are on holiday. People are on holiday. Secondly, it's packed up. There are meetings are going on over continuous. All other committee meetings.
Room availability is
That's I got from the diary room that he sent.
Okay.
Friends, thank you very much. Thanks for your time.
Please will thank you because it's still
Yeah,
not okay.
you can see me next.
first part.
नेक्स्ट टाइम सबको यही मटेरियल लाने को बोलना है
next time we will material.
लगा नहीं
SMS में ये भी आना चाहिए.
आराम से
कैसे खाई